GST stands for Goods and Services Tax. It will replace all indirect taxes levied on goods and services by the central and the state governments. Already adopted in more than 140 countries, it has been tested and proven to work well with the public and the government. We bring you the experience of GST in 5 countries. Number 1. Australia. Australia introduced GST in 2000. When GST was implemented, there was corresponding reductions in personal income taxes, state banking taxes, federal wholesale tax and some fuel taxes, leading state treasurer to claim that people were effectively paying no extra tax. The second in the list is Canada. In Canada, the GST replaced the manufacturer's sales tax and came into force in 1991. It left Canada in a position to eliminate its deficit and proved so successful in generating revenue for the federal government that the rate has since been reduced to 5% from 7%. New Zealand. New Zealand introduced GST in 1986. The laws in New Zealand ensured that prices on headlines must be GST inclusive except when business claimed to mainly wholesale client base. It raised revenue to finance government and also removed very inefficient taxes. Number 4 is Singapore. GST was introduced in Singapore on April 1, 1994. It is a multi-stage tax that is collected at every stage of the production and distribution chain. GST allowed reducing in existing taxes such as the top personal income tax rate and increased subsidies for some public services such as health and education. 5th, Malaysia. Malaysia is last country to implement GST. The existing GST rate was effective from 1st April 2015. The 6% tax replaced a sales and service tax of between 5 to 15%. Since it is already well received and implemented in more than 140 countries, the debate is still on whether GST will be passed during ongoing monsoon session or its fate will be decided in the next session.